Tuesday, September 3rd, 2019, Maneco 64, home of alternative economics and contrarian views. Before I start today, Billy and I would like to thank for all the viewers' support, all the new subscribers. We're above 25,000. Thank everyone for their contributions through Patreon, PayPal, or through cryptocurrencies, through buying merchandise like this in the Teespring store, Maneco 64 Teespring store. This is the time to retire the old lady of Threadneedle Street and shut down the bank's doors mug. Lady of Threadneedle Street is the nickname for the Bank of England. We've also got the Fed mugs. We've got t-shirts and everything else. Thank you very much. It helps keep us going and focus even more on bringing the message of sound money, Austrian economics, which focuses on freedom, free markets, small government, and sound money as well. So today, talking about sound money, I want to talk about how negative interest rates would be the beginning of the end for the fiat currency system. Negative interest rates for the US dollar, of course. And I will reference Professor Fiat for that. He's been writing for years about something called backwardation, and that's to do with the futures market. Before that, of course, I want to look at where the markets are this morning. The US reopens today. Yesterday, the futures did open. We were down about 200 points. The futures. Today, the futures are up a little bit compared to yesterday, but it's still down on where we closed on Friday. So it's 7:44 a.m. London time. Right now we've got spot gold at 1524.80, down about $4 or 0.25%. Range has been 1521 to 1530. Silver 1846, up about a cent. Basically, range has been 1832 to 1852. So precious metals fairly, how can I say, stable so far. Right now, I've got the Dow futures compared to Friday, it's down about 150 points. But from yesterday, it's up 32. We're at 26,250. It closed at 26,514 on Friday. S&P as well is up on yesterday. It's at 2908, but it closed at 2926, so we're actually down 18. This is the problem here when we get a holiday. My IG index system compares it to the close yesterday, and yesterday the futures were open, but we're actually down from Friday. The NASDAQ is at 7636. That's up 20 from yesterday, but it's also down, of course, from Friday. The major move that we've seen in the last day or so in currencies is the British pound, and that's why I sit here and I'm actually, yeah, it's concerning because I live here and I think it's very serious what's happening to the currency. The fiat currency that we have to use in this country. It's going to mean a lot more hardship going forward for the general public. Of course, the very wealthy and the people who are near the financial sector, they've protected themselves, even though they will get hurt as well. So right now, the pound is trading below 120 versus the dollar. So £1 is buying less than $1.20. Don't forget, just before the 08 crisis, £1 bought over $2. So where's the outrage by Donald Trump for the UK manipulating its currency down? I mean, what should the UK do, or the Bank of England that's supposed to be the guardian of the currency? Well, they should raise interest rates. That's how you attract foreign capital to a declining currency. But of course, interest rates in the UK are below 1. So right now it's down 80 pips. sterling, or down another 0.2% at 119.84. But if you do have some precious metals, especially gold, you're being protected, because right now 1 ounce of gold is buying 1,273 pounds. So that's very much the all-time high, I would say here, or very near the all-time high, 1273. The euros come off as well, not down as much. It's at 109.36, down just under 1/3%. Dollars unchanged against the yen, 106.18. So yeah, the dollar's quite strong here against the major European currencies. Versus the yuan, the dollar traded up yesterday quite strongly. Right now it's virtually unchanged at 718.71. We've got WTI crude 54.50, Brent is 58.40. The bond market 10-year yield is unchanged. So treasuries will start trading again today after Labor Day holiday yesterday. We're at 151, 10 years, I said, unchanged. The 2 years at 151.8. So just slightly inverted the yield curve there. So why am I saying that if the Fed were to bring in even zero rates, but especially negative interest rates, why would that be the nail in the coffin of the fiat currency system? Well, because the dollar, of course, is the reserve currency of the world, and everything, especially commodities around the world, are bought in US dollars. So if the central bank sets negative interest rates and tries to get people to get out of dollars, they're going to get into commodities. They're going to get into especially precious metals. And that's what I want to talk about, backwardation. And I want to reference an article from Professor Antal Fekete. Professor Antal Fekete is from the New Austrian School of Economics. He lives in Canada. He's Canadian. He's originally from Hungary, I think. So he immigrated to Canada many years ago. He is a gold bug, a sound money advocate. So I'll try to quickly explain what backwardation is. Basically, in the futures market, for example, if you buy gold 3 months from now, usually the price is higher than the spot price. And why is that? Well, because the person who sells you the gold forward, when he sells you the gold and takes the cash, he'll want extra from now, because he will have given up the rate of interest on his cash, on his dollars, over that 3 months. So that's why the spot price of a commodity is always lower than the forward price. And that's called contango, and that's how normally the futures markets work. And it's the same thing for soft commodities, even though in soft commodities like grain, just before the harvest, there's a kind of a shortage of the grain. So the demand for the cash commodity, for the spot commodity, is very high. So sometimes the spot price will go above the forward price. It's very cyclical, and that's called backwardation, when there's so much demand for the commodity in the now, or in the cash or spot market, that the forward price is actually lower. So what does that do? It encourages people who hold that commodity to sell it because there's a shortage. Sell it for X plus 1, and then buy it in the future for X and make that arbitrage gain. In gold, Professor Fekete argues that permanent backwardation would lead to the complete collapse of the system. Permanent backwardation in gold, of course, because it would mean that the demand for gold would be so huge. What he says as well is that demand for gold is not like for any normal grain or commodity, because gold is money, right? And people want to hold on to it. So even if the price is higher than the forward price, people will not sell it like they do in the other normal commodity markets, mainly because it's money, right? It's a monetary commodity. So Professor Fichetti has argued for many years that permanent backwardation would lead to the collapse of the fiat money system, the irredeemable dollar, as he calls it. We have had periods of backwardation in gold and silver, but they are not permanent. So what's this got to do with negative interest rates for the dollar? And why am I talking about negative interest rates? Well, because we know that interest rates around the world have collapsed recently, not only in Europe, but in the US. We've got $17 trillion of bonds yielding negative rates. We've seen the German government sell 30-year bonds for a negative yield. And there's a lot of talk that the Federal Reserve is going to have to cut rates aggressively, and that they might even go not even zero, but also negative. So how would that affect the futures market and the commodities market? So what would that mean for the system? In my opinion, humble opinion, and this is what Professor Fichetti says as well, and this is what other people like Alasdair Macleod are saying as well, that if we have bank deposits actually losing value in US dollars, and as the dollar is the reserve currency of the world, can the US and the Fed really set negative interest rates? Well, they can, but I think it would be, like Professor Fichetti and Alasdair Macleod say, it would be the end of the system. It could be. You never know in this day and age. Of course, they could manipulate things, but all that would mean is that instead of holding dollars, people would want real things that actually, like commodities, but especially the monetary commodities, because if you hold gold, of course, instead of dollars that are shrinking in your bank deposit or as a bond, why would you want to hold dollars, right? You want to hold gold. So that's one of the reasons why as well gold has done so well recently, because all the talk of renewed QE, zero, cutting rates, even more negative for the ECB. And what does renewed QE or money printing do? Well, all that does, it means that the central banks are buying bonds with a credit that they issue out of thin air. And by buying bonds, they drive yields lower. So, and the Federal Reserve has actually been doing QE on the sly. I've seen articles showing that they actually been buying bonds recently. So that's what it would do. I will put the link to Professor Fichetti's article. It's entitled "The Dangers of Permanent Gold Backwardation" by Professor Antal Fichetti. It was written, I think, in 2013. I've been following Professor Fichetti for many years. I think it goes back to 2006 or 7. One of my colleagues, fellow gold bug at MF Global that I used to work with, he introduced me, I think I introduced him to Professor Fichetti. I found out about Professor Fichetti, but then he got really, really into Professor Fichetti, and he always used to forward me all the new articles, and this is a classic. It explains why permanent gold backwardation would lead to the collapse of Western civilization. Even that's how serious it is, according to Professor Fichetti. It's a long article. It's not easy, but I recommend you read it. I would read it a couple of times or even more to really understand what's going on. So how can we tell, just to finish off, how can we tell that we're moving more and more towards zero or even negative interest rates in the US dollar? Well, there's a futures contract called the SOFR futures, 3-month SOFR. The SOFR is the new interest rate reference that the United States, through the Federal Reserve and the Treasury, are replacing LIBOR with. So, and why is this important? Well, because it's basically what the market, where the market thinks the 3-month rate is, and the 3-month rate is very close to the Fed funds rate. So the way this futures contract works, normally when I was in the futures market, if the interest rate was 0, it meant that the price of the futures was 100, because 100 minus 100 equals 0. If the interest rate was 5% a year, the price of the future would be 95. So 100 minus 5. And no one ever thought, maybe 15, 20 years ago, that you could ever get a price more than 100 in these. But of course you can now. The euro, 3-month euro futures, they're over 100, which is something crazy. So the way to know what's going on, and if we are close to getting negative interest rates, in my opinion, is to look where these futures are. And what I've done is going into the CME Group website, the futures exchange. You look at December 21, they've got it at 99.01, so that means a 1% rate. So I'm going to keep an eye on this, and if I ever see these contracts moving towards 100, that's a bad sign for the system, good for precious metals. So there you go. If you enjoyed this video, make sure you hit the like button, subscribe to the channel if you haven't yet. You can also follow me on Twitter, Steemit, and on DTube. I wish you all a great day. Take care. Bye.